Good morning and welcome to The Street today, here from Post 35 on the new site of the New York Stock Exchange. It is Tuesday, February 7th. I'm Katherine Ross and I'm filling in for JD Durkin. We are about an hour into the trading session and all three indices are lower as investors continue to digest corporate earnings and eagerly await comments from Fed Chair Jerome Powell on the state of the economy. On the show today, we will be talking about what to expect from Fed Chair Jerome Powell when he takes the stage in Washington later today. Plus, we'll dig into Pinterest's fourth quarter results as that company posts a big earnings miss. And finally, the Super Bowl is just days away and Americans are placing more bets on the big game than ever before. For more on these and so much more, let's bring in our special guest, Steve Sosnick, Chief Strategist at Interactive Brokers. Now, Steve, markets are lower this morning. What's driving investor sentiment at this time?
Today is a very mixed day. I think, we're waiting for Chairman Powell's speech in about 2 hours from now. In my mind, it's one of the weird times where you had a guy give a full press conference less than a week ago, but circumstances have changed so much between now and then, and because what he said was sort of so unexpected, I think people are waiting eagerly to see whether his message continues along the path he took last week, or if circumstances have changed, or if he misspoke, and so we have this real waiting for Godot type of feeling, is waiting for Powell right now.
Do you think we're going to get a tonal shift?
I thought we were going to get a tonal shift last Wednesday, and I was quite wrong. I really, I put something out, which I'm not. I was wrong. I admit it when it happens. I put out something saying we were going to get more Jackson Hole Fed than Goldilocks Fed. He, for a lot of his term, he's been what I call Goldilocks. He's been able to take some negative stories and, spin them in a positive light. I really think that's more his personality. I think Jackson Hole was sort of the Mr. Hyde to his normal Dr. Jekyll, let's say. If I continue to stretch analogies, I'll come up with a few more. But bottom line, he didn't. There were a lot of opportunities for him to, they threw him some softballs, and he didn't swing at them. He basically, kept using that term disinflation, which, being a new term, I think the market took that well. Everybody took it well. You could see each time he said it, the market kind of rallied. Disinflation still means we have a lot of inflation. It can mean we have a lot of inflation. In this case, it does mean we have a lot of inflation. It's slowing down, but that's a second derivative. The first derivative is inflation, which is the change in prices. And so I think that it'll be interesting because my analogy was to the July press conference, which was the only one of the 6 prior press conferences when we actually rallied afterwards. Over the rest of the weeks of each of those press conferences, 5 out of the last 6 we went down, and down hard in many cases. That one we went up, and everybody fixated on the term neutral, which at the time, by the way, was 2.25 to 2.5, which seems almost comical in the rearview mirror. And he went out of his way at Jackson Hole then, a few weeks later to say, no, wait, after pretty much every Fed governor back-talked him as well. You haven't had a ton of back-talk from the Fed governors. Bostic yesterday definitely, did his best to throw some cold water. Kashkari as well. And so let's see, is this, do you get him changing his tune that quickly? It's also a credibility issue if he does that too. So there's a lot of moving parts for a guy who we just heard from at length a short time ago.
Yeah. Let's turn a little bit to the markets. As the action that we've seen since Friday is just kind of, you said cold water, and I would say that this rally has had cold water thrown on it. Do you think that the jobs report number that we got on Friday ended the bear market rally that we saw?
It might have, although the momentum is still strong, which is part of it. It definitely was a major turning point in fixed income. It was potentially a major turning point in the dollar. Stocks still have not given back their Fed move, though. If you look at, let's say, the 2-year, which to me is a great benchmark for what we're seeing, went from 420 before the meeting, 410, afterwards. We flirted with 402 or so on Thursday, and then as of yesterday we're at 445, 446. This is an asset that doesn't move very much, and so think about the volatility in what's considered a safe asset. Dollar, not as, the DXY, let's say, 102, 101 up to 104. These are big moves. Stocks came off on Wednesday, but not nearly as hard as they went up on the Wednesday. I'm sorry, Friday. They didn't go not nearly as hard as they did the Wednesday and Thursday sessions. And yesterday was kind of a meh decline, a little bit of profit taking, whereas the bond move continued. One of my themes is it's very hard for risky assets like stocks to get too much life in them when it's very hard to price risky assets when you can't price the non-risky assets. And that's tricky right now. But the momentum we've seen, we still see a lot of action in very speculative stocks. We still see a fairly charitable read on earnings, and so it's a little premature to call the late bull rally dead. Although I would say it's definitely on the watch list.
Okay. And then, we started out this year with a lot of economic data that wasn't what we wanted to see. However, later in January, we started to get more economic data that outperformed estimates. Do you think that that's helping to kind of cool off the recession talk that we had started to hear from different analysts?
Well, yes, I think it has. And certainly Friday, was an eye-popping non-recession number. The market's really got to decide what it wants here. And that's partially why I think we're still sort of trying to find a level a little bit. We've got two schools of thought. The bond market is telling us quite clearly that they're afraid of a recession. We could spend another hour going through every inverted yield curve or parts of the yield curve, but it's quite clear that there's an inverted yield curve, which is usually a very bad warning sign about the bond market fearing a recession. And the bond market tends to be more right than the stock market, although they overpredict recession. That would bring the rate cuts. There's rate cuts priced in, 2 rate cuts, let's say, within the next year. What's going to give us those rate cuts? It would have to be a recession. And the stock market, I think, is sort of fixated on this idea of a soft landing, and then sort of taking that to some magical thinking about we're going to get an okay economy and rate cuts. It's not going to happen. The Fed has told us, first of all, just think logically. Besides whether or not you trust what the Fed people tell you that we're not going to cut rates, blah, blah. If you've went to all this trouble to hike rates at pretty much the fastest pace than any of us have ever seen, are they then just going to turn around and say, oops, my bad, we're going to start to cut them like 2-3 months later? No. They'll only do that if there's a reason. And be very careful what you wish for if that's your investing philosophy. I think what we're going to have to see is some idea of whether good news is good news or good news is bad news, and vice versa. And I think if we want to see the good economy, we want good news to be good news and bad news to be bad news, that kind of idea. And I think we're still getting mixed messages in terms of how the stock market's reacting to things. And that to me is the big existential question for markets over the next few weeks and months. And I wish I could tell you, it's going to be this or it's going to be that. That's a tough one.
If only you had a crystal ball.
Exactly.
Both Bostic and Kashkari, as we've kind of alluded to, came out, said basically that they foresee more rate hikes on the table. Now, for Kashkari, that could be anywhere from 4.25% to 4.75%, and even Citi says maybe up to 6% on the Fed funds rate. How should investors digest that?
Think about it this way. I mean, at this point, the rate hikes, whether you get an extra 25 basis points here or there, I think is somewhat secondary. Realistically, if we peak at 5, or if we peak at 5.5, or we peak at 4.75, what does that really mean to the price? Fundamentally, to the price of stocks that are meant to be, pricing in the next 5-10 years worth of just dividends, earnings, et cetera, cash flows. But of course, the market doesn't think that way. If that was, there's not that. The market sort of follows the bond market when it's convenient and doesn't when it doesn't. I think the key here is it's the tone. And so it's still that rates are headed higher, not lower, in the foreseeable future. At best, we hope they stop. Where they stop, if it's within 25 or 50 basis point range, doesn't really matter that much. And by the way, one of the things that they still don't talk about is there's quantitative tightening going on in the background. So the Fed is running down their balance sheet, and that's another sort of way of putting on the brakes. I was going to say like easing off the accelerator, but that they did a while ago. So at some level, you are still fighting the Fed. It's just a question of how hard are they fighting back, and whether or not the terminal rate is higher or lower. The market will adjust to it. I think you can have some shocks in between, but I'm not as concerned with where we end up as to how we get there and what happens after we get there. And I think that's the divergence.
Yeah, and right now what we're seeing is how we're getting there is not necessarily matching up with what the Fed's plan has been, right? Because we're seeing the jobs number come in so much higher than we expected, and even Kashkari coming out and saying, this was a bit of a surprise for us. When they're trying to digest that, you mentioned Powell saying disinflation a lot in last week's speech. Do you think that there's going to be one word that could just catch investors in the market's attention and just let those algos run with it?
I think if he stops using the term disinflation, that to me would be the bigger tell. Like if he really goes out of his way to avoid using it, realize, like as he looks back and goes, oops, maybe they overreacted to that one. That's really, to me, the word, the lack. I know that's like impossible to say, the lack of something, and I guess that would be the word if I would be keying on. If I were back still writing algos, that would be the word. That would be the word I would be looking for most. And then after that, let's see. But pace of hikes. Again, the phrase that goes unspoken is balance sheet reduction / quantitative tightening. Let's see if he picks up on that. I'd imagine at an economic club, somebody's going to ask him about that. But we'll see.
Let's hope.
Exactly.
Let's move into earnings a little bit, because we did get earnings from Pinterest, which, as I said at the top, did disappoint Wall Street. The guidance especially was just not exactly what investors wanted to hear. Why do we keep seeing these digital media companies miss?
I think first of all, it's tough to monetize that business. I'm not strictly an analyst on those stocks per se, so I can't get as granular as some of the other people you might speak to. But it's a tough business to monetize. Tastes can be fickle. And difficult. It's tough to understand like why a certain social media platform is in vogue one month and not another. There's secular trends, but when you have to report quarter to quarter, you don't know. Advertising, monetizing this is tricky though, and that's really, I think, the big problem you have. And again, look at Meta, which was a disaster for so long, and then they sort of figured it out a little bit last quarter, and the market loved it. So I think it's how investors are disposed to think about things, and at least this morning they're a little less freaked out by Pinterest than they were last night. So again, that was kind of a theme we've seen. I would say in general the market was fairly charitable for the most part during earnings season, and so we can take it where we will. But in terms of why social media company A is better than B, I'm going to throw back my hands at some extent and say that's a mystery to me. I can tell you how the market reacts and why, but the underlying, I'll leave that to you.
Okay, fair enough. Charitable is an interesting term to use in response to this earnings season, where last week, for example, with these tech earnings, you think that the market was being charitable to them?
They were not uncharitable. I mean, the one I wrote a piece last week, I guess probably 2 weeks ago now, where I contrasted Tesla and IBM, and basically they both beat on the top line, they both beat on the bottom line, they both missed horribly on cash flow. Actually, Tesla more horribly than IBM. Tesla, Elon Musk said good things at the conference call, and they didn't really overlook the fact that they missed cash flow by like $2 billion. It's a couple billion here and there, right? And so the stock, and we all know what happened to the stock afterwards. IBM missed by a few $100 million, but they're a dividend-paying stock. Their investor base is completely different than Tesla, which is kind of ironic because 50 years ago or 60 years ago, whatever it was, they were the Tesla of their day. They were the stock that was going to be the killer in perpetuity. And so a lot of it has to do with where we've come from before. So I do think a lot of what we've seen is January effect. So a lot of the stocks that have performed best have been the ones that have were beaten up. I've already mentioned Tesla and Meta, and look at what they both did last year. IBM wasn't quite as terrible, and their investors, who are value investors and love that 4+% dividend yield, They don't want to see anything threaten that dividend yield. So the stock is, so it really, to a certain extent, depends who your investors are and what they think about. So the growth, I think the growth, I guess I probably can narrow it down and say some of the growth stock investors were a bit more charitable recently, whereas I think some of the value stock investors, it was more mixed results. They wanted to see the bottom line, cash flows, money returned to shareholders, whether it's buybacks or dividends, and they reacted accordingly. So I thank you for calling me out on that one, because I think that it needed a bit of clarification.
It was an interesting term, and I'm glad that you explained it. Let's look at Uber real quick. So we are expecting earnings from them.
Okay.
What do you want to see in that earnings report? Do you think that investors can be charitable towards them?
That's again, possibly because of that sort of January effect idea, where where the stocks got beaten down hardest in 2022, sort of have a lower bar for success. It was very interesting because I had traveled last week, and out of the blue, as I was about to book an Uber because I'm in an unfamiliar city, I got a thing on my phone, 20% off your next 2 rides. It was like, oh, that's perfect. I'm going to and from someplace that's not particularly close. I'll take that. Companies don't do that. I always wonder why. What is the motivation for doing something like that? That's a weird anecdote, but I think you just want to see the path to sustainable profitability. Uber's costs definitely are not going down. I mean, yes, the price of gas is going down, which helps their drivers, but they don't pay that cost. But the price of their labor, and they've been raising prices, and what's the elasticity of demand for something like that? How much, if you raise the prices, does the demand stay? And so these are the things I'd be looking for. Of course, do they beat, miss, and the guidance is. There's a certain amount of alchemy at the conference call. Is the chairman seem upbeat, or does he seem like he had a bad day? That kind of at any conference call. But that idea, are they really how are they dealing with cost pressures? How are they dealing with labor shortages? And does that affect the sustainability of their model?
According to FactSet, we're on track to see a 5.3% decline in earnings overall. We're now halfway through earnings season. We talked a little bit about how you think that investors have come in and given the benefit of the doubt to some growth companies. But overall, when you approach the stock market and you look at earnings that we've gotten, how do you feel about them?
To me, it's tough to make a case to be gung-ho on stocks when earnings are declining. That's sort of, you want to be in a rising earnings environment. There was a chart in the Wall Street Journal, I saw it over the weekend, and it was that the earnings yield on the S&P, and I've always been a little bit murky as to how different people calculate that, so I'll just have to accept the chart as it was printed. The earnings yield on the S&P 500 is pretty much among the lowest levels we've ever seen. Only other times it was this low were in 2007 and early 2008. We're in late 2000, early 2001. Are you sensing a pattern here? 1990, which all three of those eventually became recessions as well as bad stock markets. And the other one was like 1987. Now, I'm never one of these people who, because I see you on Twitter a lot. I know we interact there. There's all these, we've never seen Breath do this, that, and the other thing at the same time. And there's a million of them. And they are all positive, and they explain the momentum we're seeing. So I don't love relying, though, on these, indicators that come up once every however many years. But to me, that's a fundamental. When you buy a stock, you're paying for its earnings. You're paying for its dividends, you're paying for its cash flows. You can plug in one of those three into the model because eventually they all end up in the same place, right? If you're earning money, you could pay dividends, or you can, if you're earning money, you have cash flows, et cetera. If we're paying too much for earnings, that typically doesn't end well. And I'm not saying that means we're put on your crash helmets, everybody. But I do think there has to be a little bit of a reckoning if earnings are coming down and stocks are not, we came down to a large extent, I think, in advance of this notion. But you've got to see the earnings recover. And again, if we're worried about a recession, that really puts some headwinds on the stock. So that to me is my cause for concern, and you hit upon it because you can't ignore earnings. Ultimately, that's what matters. That's the whole reason why we're here.
Does that mean that answer inherently was negative, which leads me to wonder if you see the market as it is right now as a buying opportunity, like any stocks that you'd be watching?
I can't do recommendations, so I'm just going to be. I'm going to say, like, I tend to look for value. First of all, I've tended to distinguish less between value and growth than I have in the past. I think that distinction, which always has been a bit artificial, why is the stock that trades at that post a growth stock and that guy a value stock? Somebody has to decide this. It's not always, particularly on the margins, it's a murky thing. And I discussed, let's say, the difference between IBM's crowd and Tesla's crowd. But to me, you have to start looking in an environment like this where people are not just paying up for growth, or where momentum is not the big overriding factor. I want to be looking at something where I can get it at, where there might be growth involved, but I'm not paying a premium for it. Some examples of that: Google's PEG ratio. I use the PEG ratio. It's a crude factor. There's obviously a lot more nuance in this, but that's one of my first screening points. So the PEG ratio on something like Google, Alphabet, Google, around 1.1. AMD, before it rocketed up on earnings, was like a 0.7. So to me, I want to be finding stocks that sort of fit that criteria. I threw out 2 tech stocks. It doesn't have to be tech stocks, but I want to see things of that nature. On the other hand, I look at oil stocks, which to an arguable extent don't necessarily grow but return a lot of cash. I look at XLE, where it is, let's say, versus the price of oil, and start to wonder, is that, I can make a case on both sides for undervaluation and overvaluation at the same time. I think but I think the amount of stock, the amount of buybacks, the amount of dividends that some of these stocks are paying back to their shareholders makes them at least a place to hide out right now. And I also kind of do believe in consumer staples, because bottom line is we all have to eat. We all have our certain things we have to do. And if we do have to be concerned about recession, that's something, I know they're not a sexy name right now, but they can provide a little bit of value and ride you through things.
I mean, it's not even, if we're concerned about a recession, look at the food inflation prices right now.
Exactly.
It makes sense that consumer staples would be something that you're looking at.
Exactly. That said, Tyson completely defeats that argument, because you'd think people would be eating chicken in this environment, switching from beef to chicken or whatever. But sorry, I immediately deflated my own argument. So that's what I mean, is it's very hard to sort of.
It is. It's a difficult market right now, and that's when I'm looking at this market. I always wonder, from a new investor's perspective, what are they watching for? What do they need to know? So, what are some investing tips that you have for these newer investors?
Rule number one for investing is don't fight the Fed, and so that is why I have a cautious tone in everything I say right now, because it's much easier to invest when the monetary tide is flowing in rather than out. Rising tide lifts all boats. I'm a king of analogies today, but that's kind of where I'm going. So right now that's one thing to keep in mind. My second is earnings in the company, and the company itself matter. They're not just names on a piece of paper. And it's very easy to get seduced by big moves, which, the meme stock. I mean, look at Bed Bath & Beyond yesterday. These, somebody made a lot of money, somebody was left holding the bag, and so, I guess that's another thing. If you're, I'm not going to say don't follow social media. Don't get a range of opinions. Everybody I know who's been in the business a long time is a sponge. They try to get as much information as they can, but if somebody is talking to you who has an obvious agenda, and I know somebody right now is going, you've got an agenda too. And I'll be upfront. My agenda is I want our customers to last as our customers and stay in the game and have money to invest. So that's kind of my angle. All right, that's what I'm pushing, and that's kind of why I'm a little, always a little reluctant to jump into the next speculative trend, because to me, capital preservation is as important. Return of capital, particularly when times are tricky, is as important as return on capital.
Well, Steve, thank you so much for joining us today. I really appreciate it. And I love the insight that you brought to the table. So I really appreciate you joining us today. And coming up, we'll bring you the latest headlines on FTX and Bed Bath & Beyond. But first, we sat down with a few experts to discuss their tried and true investing tips. Take a look.
Put a plan in place and you stick with it because the moves are unpredictable. We do think the bull market will return. We just don't know when. Timing it can be a little difficult. Try not to get too cute. If you want to get into this market, we would do it gradually. I would gradually deploy to your own risk tolerance level, not throw it all in one day.
Charting matters. Having some kind of a understanding of the major moving averages that all institutional investors use. So it would be the 50 and the 200 day moving average or the 50 and the 200 week moving average. Because if you look classically over the last couple of years, when we broke those, that's when we saw the big decline in 2022. And as we're clearing them is where we're seeing more buying. So I think it's good to have some kind of a navigation system, if you will.
I think the most important thing for individual investors right now, for the first time in nearly a decade, you have the ability to not just look at equities, but fixed income. You're actually getting a return. You haven't been paid in fixed income or that 40% of your 60-40 portfolio in a while. So pay attention to that. And there's some great opportunities out there.
I'm telling investors, make sure you're investing in things that you're fairly confident will continue to pay a yield and grow that yield, to have the business model and the cash flow generation ability to grow that yield over time. And some of the places we're seeing that right now, even though you'd argue that many energy companies long-term are value-destroying business models, I think energy is still in the sweet spot. I think cash flow for energy companies is going to continue to be very strong in the kind of economic environment we're predicting.
Thank you to each and every one of our experts. And now let's get you caught up on some of the biggest stories that we're watching at TheStreet. Betting on this weekend's Super Bowl is projected to hit record-breaking levels, with more than 50 million people set to gamble on the big game. This is according to a survey by the American Gaming Association. This figure, which represents 20% of the U.S. population, is more than double last year's estimates and marks the first Super Bowl to be played in a state where betting is actually legalized. The wagering is calculated from bets on everything from legal sports books, illegal bookmarks, or casually among friends and family. This blowout estimate comes as sports betting continues to explode in popularity, and as of right now, 32 states, including Arizona, have legalized sports betting. And shares of Bed Bath & Beyond are taking a nosedive this morning after the embattled retailer said that it would raise $1 billion through a stock sale as it looks to avoid bankruptcy. The stock initially jumped on the news, with shares climbing 92% during the trading session on Monday. Bed Bath & Beyond has been struggling to stay afloat for months as it fights to stay relevant among a broader shift to e-commerce. Just this morning, the retailer announced plans to close 150 more of its stores, bringing its total of shuttered brick-and-mortar locations to 400 just over the past year. And finally, FTX is asking politicians and campaign committees to return the millions of dollars that it donated before it went bankrupt last year. The crypto exchange, which collapsed back in November, said that it made the request via confidential messages and is threatening to sue if the funds aren't returned by the end of the month. According to Federal Election Commission records, founder Sam Bankman-Fried donated over $40 million during the 2022 midterm cycle to both Democratic and Republican organizations. That'll do it for TheStreet today. Thanks again to our special guest, Steve Sosnick, Chief Strategist at Interactive Brokers, for joining us this morning. And stick with TheStreet for more on these stories and all other major market stories that matter to you. We will see you tomorrow.